Good afternoon, everybody. My name is Paul Burkett, and every week I take 10 minutes to give you a quick roundup of everything that's going on in the real estate world, the mortgage industry, and the economy more generally. This week I'll be talking a little bit about how the world is reopening, an analysis of the federal unemployment program, which is paying people to stay home, a quick review of the horrific scenes we've seen, certainly in Manhattan over the last few days. My walk to work is now through a world of destruction. A little bit of an update on what's happening with commercial property, with rents, and also with the mortgage world. And then I'll finish it up on where all the money has gone, because there's been an enormous amount of stimulus, but where has that cash actually gone? So let's get started. Everyone's worried about a second wave of infections, and maybe they'll come and maybe they won't. I was reading an interview this morning with the Swedish Minister for Health, and in Sweden you might recall that they didn't have such aggressive lockdown, and their death rate was up over 13%, which is pretty shocking. But they said in hindsight they wouldn't have been so liberal and would have been more aggressive in locking down their cities to stop the spread. As you know, we're seeing cities starting to reopen across the US, and this map just from Johns Hopkins breaks down which states are doing well, which are not so well. The two hot spots of Arizona and Maine, but a lot of places doing a lot better. Certainly New York, we're starting to see a bend in the trend, and New Jersey, where those rates are down and staying down, which is really good to see. I got a few questions last week about this particular chart, which was, what was I trying to show here? And what I'm trying to show is simply the relationship between the unemployment and stimulus checks that are being mailed out across the country, compared to what those people who received those working in those industries would have earned had they been working in full-time employment. So this chart just shows across food service, cleaning and janitorial work, medical assistance, sales and retail, all the way up as far as even entry-level IT jobs, what you would earn as an employee compared to what you earn under the stimulus program. And as you can see, it makes a lot of sense for a lot of people actually not to work, but just to stay home, and that's what they are doing. My walk to work, I mentioned last week, was through leafy Soho. Leafy Soho is not quite so leafy, as you'll see here. Not only has there been just spray paint vandalism, but also quite a bit of vandalism to the stores as they've been looted and smashed. Last night was a little bit better than the 2 nights before, but we've had helicopters in the air all night since Sunday night. So dangerous times ahead. In fact, even now in Manhattan, there's a curfew. So I'm recording this at about 6:30. I've got to be out of here by 7 so that I can be home by 8. You're not allowed on the streets in New York City after 8 p.m. A lot of people have been struggling, both at the high end, which people don't worry about, but also at the low end. Entry level, low income homeowners have really been struggling as rents and mortgage payments have increased for them. And up until very recently, one of the most frequent search terms for Google was rent assistance, as people were looking for ways to reduce their rents. And while it's anecdotal and an example just of one, my lease is up for renewal right now, and my landlord proactively came to me and said if I'd stay, he would reduce my rent by about 15%. I will be staying, and 15% is much appreciated, in case he's watching. This chart just breaks down rents for a single bedroom in the 4 most expensive cities in the US. And as you can see, San Francisco, New York, and Boston, down double digits for New York and for San Francisco versus the prior record. And I expect further rents reductions. A lot of people leaving New York. At the weekends, I count all the U-Haul trucks leaving. There are lots leaving, but very few arriving. And so I think that we're seeing a hollowing out of big city, not just because of the current riots, but also the work from home implication for people. They can get a lot done. I've been speaking to a few people, law firms, loan servicers, people who are heavily reliant on labor to conduct a lot of repetitive administrative tasks. And what they're all reporting is that their productivity dipped initially, but has now gone up since everyone has been working from home. I've also been closely tracking the forbearance monitors from Black Knight, and we've gotten now to a position where approximately 8.5% of all the mortgages in the US are in forbearance. And I hear again from servicers and other anecdotal reports that about 50% of the people in forbearance are actually making the payments anyway. And I'm sure that means that they're going to be seeking refinancing as soon as the moratorium is complete. But for now, for the next 9 months or so, they don't need to make any payments, and there will be no adverse reporting to credit. There is one important thing to note about credit, though, which is while it is not a derogatory remark, on every credit report there is a free-form text box that the loan servicer can populate. And I believe they will populate those boxes with a COVID-19 tag to let other people know that when they are assessing this borrower for future credit, that they did take advantage of that forbearance. And I, for one, would not be taking advantage of forbearance unless I absolutely needed to. But just breaking down this chart a little bit, we're basically seeing applications slow to a trickle, very few new applications. Ginnie Mae being the most flexible lender, I guess, as little as 3% down. So probably going to see the next wave of defaults coming from Ginnie paper, and less from the Fannie Freddie paper. And just for some perspective, we got to about 10% in default at the peak of 2000, I think it was 11. I'm not sure we'll get to that again, because out of the roughly 9% that are in forbearance, half of those people say they can make their payments. So I'm not sure we'll get to 10% again, but I do think we will see a spike. And unsurprisingly, we've seen a fall to basically zero of new foreclosures. There's no need to file foreclosure now because everyone can get forbearance, so no one starting on those new cases. I wondered where was all the money gone, and so this just is from the Federal Bank of St. Louis, Missouri, and it charts three things over the last 30 years: personal savings, consumption, and the Federal Reserve. And just zooming in on it a little bit, just here at the end, it's just showing an enormous spike in federal spending as a result of the stimulus, an enormous spike in personal savings because there's nowhere to spend money right now. And then lastly, a huge reduction in personal spending because, as I say, there's nothing else to do with the money other than save it. And we've actually seen that in our own loan book. As you know, we buy non-performing mortgage paper and get it reperforming. And this is just a sample portfolio that I pulled. We bought this portfolio at the end of 2008. We're currently in month 19. And typically when we buy a portfolio, you'll see a big spike of collections at the beginning as people deal with their outstanding debt. And then that declines over time. And often we're foreclosing at this stage. But now what we're finding is borrowers calling in, and clearly they're calling in because they have more cash available, and many of them reference that when they speak to the loan servicer that they're in a position to reinstate. I also spoke with a couple of collection agencies this week, and they both said that May was a record month for them. So the cash that's in people's pockets is being reflected in people paying down legacy debt. Lastly, I just pulled an analysis by Bloomberg of bankruptcies. So where do we stand compared to previous years? Remember, we're only halfway through the year. 78 bankruptcies. These are Chapter 11 and Chapter 7, which is basically liquidations and reorganizations for corporations of less than $50 million. I think when you roll in slightly larger organizations and we get into June, July, and August, where I think retail will continue to struggle, we will see us probably break that 200 level that we saw in 2008. So I do expect more bankruptcies, and that will result in layoffs because it can't not result in layoffs. And remember what we saw last time when we had a recession like this. It's those older folks, people 50 and above, I now count myself in that group, who struggle to get jobs once the economy reopens. We saw unemployment rates 17% worse for older people and 25% worse for people over the age of 62 in the last recession. In terms of other trades, I have an announcement to make, but I'm not going to make it just yet because we haven't funded it, but we do have two transactions happening this week. It seems that sellers are seeing the light a bit more and realizing that they're not going to get the prices they were holding out for in April and May. So let's hope June, July, and August are better months on the trading front. if you find these videos helpful, please do like them, and even better, leave a comment or share them with your LinkedIn audience or your YouTube audience. It helps us find other banks that are selling, and it also helps us find people who are interested to work with us as lenders or investors. So I'll leave it there. I will brave the curfew and head home, and I will speak to you again next week. Please do have a great weekend.